Imagine someone told you a financial hurricane was on its way, not just as a figure of speech, but as a real, predictable event. Today, we're going to break down a very specific strategy for protecting your wealth, one that's built on the idea that a major storm is already forming on the horizon. So let's take a look at the warning signs. And look, this isn't just some clever line. It's the core belief that's driving this entire strategy. The idea here is that the financial warning signs are as obvious and as serious as a hurricane warning on the news. This isn't about some vague prediction. It's about reacting to a threat they see as already visible. Okay, so a hurricane is a pretty powerful analogy, right? But it's got to be backed by something real. So what are the specific things that are causing this level of alarm? Well, the argument points to a few key factors that, when you put them all together, paint a pretty serious picture of an economic downturn. All right, first up, let's look at the actual warning signs of this financial hurricane. So here's how all these pieces supposedly connect. The argument kicks off with a national debt that's so massive there's really no intention of ever paying it back in the traditional sense. So what's the solution? Well, it's accelerating money printing. We're talking $1 trillion every few months to purposely devalue the currency and basically inflate that debt away. And according to this viewpoint, all of this is being hidden behind jobs data that often gets revised downwards later, masking what's really going on with the economy. You know, this whole idea of inflating the debt away, it's not some fringe theory anymore. The source points to major credit rating agencies, like Moody's, who are now openly talking about it. And when mainstream institutions like that start saying the quiet part out loud, that's seen as a huge signal that we're stepping into a completely new economic reality. So, if that's the problem, what's the proposed solution? Well, this brings us to what's called the $100,000 gold plan. The advice is all framed around this really simple question, which takes us from abstract theory to an actual practical plan. If you had $100,000 that you needed to shield from this storm they see coming, what would you do? So, the source offers up a blanket generic statement for a $100,000 portfolio, an 80-20 split. That's $80,000 in gold and $20,000 in silver. But, and this is important, it's stressed that it's not just about buying any old metal. It's about understanding the specific job each one is supposed to do. And this is really the crucial point. It's all about function over speculation. In this strategy, gold is seen as the primary tool for long-term wealth preservation. It's the bedrock of your savings. Silver, on the other hand, is treated more like a transactional asset. Think of it as stuff for barter, for small purchases, for when you might actually need to use it as money. And that's exactly why the source recommends smaller denominations, like 1-ounce coins. Now the strategy gets even more specific, recommending pre-1933 graded gold coins. So why those? Well, because their value isn't just tied to the daily spot price of gold. See, they have a collectible value, what's known as a premium, on top of the metal value. And in times of really high demand, that premium can literally explode, sometimes reaching over 200% of the gold's base value. It's like adding another layer of potential protection. Okay, this brings us to a really common question. What about mining stocks? Are they a form of insurance too? The perspective here is crystal clear. Physical gold is insurance. Gold mining stocks are an investment. A mining stock is a share in a business, right? And just like any other business, it needs liquidity, it needs a functioning market to operate. So in a major crash, when all that liquidity dries up, these companies can get absolutely hammered, no matter what the price of gold is doing. And hey, you don't have to just take their word for it. They point to historical data. Just look at the 2008 financial crisis. While physical gold took an initial hit of about 30% during that liquidity shock before bouncing back pretty quickly, mining stocks, they plummeted by as much as 75%. They actually fell harder than the overall market. So the takeaway here isn't that mining stocks are always a bad idea. Not at all. Instead, they're viewed as a timing play. The strategic time to buy them, according to this view, is after a market crash, when they're super cheap and the recovery is just getting started. But they are definitely not considered part of the initial insurance plan. And finally, we have to talk about the most extreme scenario that's discussed, the threat of confiscation. I know. Gold confiscation, it sounds like something out of a history book, doesn't it? But the argument here is that it's a very real possibility in a future crisis, especially with this big push towards new kinds of digital currency. So the potential roadmap they lay out looks something like this. First, physical cash is slowly eliminated from the system. Then, A central bank digital currency, or CBDC, is introduced, which would give the government total insight and control over every single transaction. And once everyone is inside that system, the final step is to close all the exits. Assets that are outside of government control, like crypto and physical gold, could be banned or outlawed to stop anyone from opting out. But there is another, maybe even sneakier way this could happen, and it's called confiscation via revaluation. The government could force citizens to sell their gold at the current market price. Let's say it's $4,000 an ounce. Then, once all that gold is in their vaults, they could revaluate it overnight to a much, much higher price. This instantly shores up the government's balance sheet, while at the same time it devalues all the cash that citizens were just paid with. And listen, this isn't just some wild theory. The source points back to 1933, the last time this happened in the US. And the result? An overnight 42% loss in the dollar's purchasing power for regular people. Just poof. And this, right here, brings us full circle, all the way back to the original strategy. A key reason this viewpoint favors pre-1933 collectible gold coins is because, historically, items that have real collector value have been exempted from these confiscation orders, which usually just target standard gold bullion. It's presented as a potential loophole against an extreme but possible event. So we end with this question. Given all the economic warnings and the potential risks that are laid out in this material, is that traditional financial advice, keep a small 5 or 10% of your portfolio in gold, is that still enough? Or does this new financial landscape we're in require a totally new way of thinking about what it even means to be protected?